Let's get back to these markets. A soft start in North American trading. Andrew Pyle, portfolio manager at CIBC Wood Gundy, joining us to talk about selling pressure. Andrew, I'm pulling up pens and papers and trying to figure out what our narrative is, and it changes minute by minute. Exactly. I mean, we spent a lot of the morning focusing on the latest with Credit Suisse. Now we also have to digest this decision on interest rates in Europe.
Well, exactly. And I think coming into this meeting today, a lot of people were playing with the idea, John, that perhaps the ECB would not raise rates at all. And of course, we had the half-point thing. So it's clear that central banks, this debate over what's more important, bank stability or inflation. Guess what, folks? Inflation is still at the top of the agenda.
And because we've got a Fed decision next week, look, the market has storylines. A lot of people said this ECB decision, is that going to influence what the Fed's messaging is? So I'll pose that question to you. If the ECB has like a playbook here where they're like, we're fighting inflation, rates are going up, however, we're ready to act if we need to, and we are seeing some potential signs of inflation cooling as we go through the year. Sounds like a nice little recipe that they tried to work up for keeping the markets from feeling more nervous in response to whatever they had to say. But does it influence the Fed, do you think, the language we get from the Fed?
You know what, John, I kind of disagree with the narrative this morning from a number of analysts that are suggesting that these things are now linked at the hip. I do not think the Fed decision next week is linked exactly to what the ECB did this morning, because when we're looking at the two banking issues going on, whether we're talking about Silicon Valley Bank or Credit Suisse, there are different issues there. Again, I think it would be a mistake to go into next week thinking that a 50 basis point move is completely off the table. I don't think we'll get a pause. I think the consensus now is a quarter point. But I don't think you can take anything off the table, especially after this morning.
Interesting. And I guess that would mean that the Fed would be okay to have sort of a target circled on it as a influential force in the possibility of bank failures, because that is already a narrative out there after two failed banks in the U.S. last week.
Exactly. But you know what? The Fed has time. Right. Lagarde did not have a lot of time going into this meeting today, very fresh after the weekend and very fresh after Credit Suisse. Jay Powell and the Fed have a week to go before we have to make a decision on rates. Now, a lot could happen negatively as well as positively, but I think the Fed's got time on its side to evaluate exactly how systemic this is or not. Take a look at the claims data this morning. No sign that the U.S. economy is falling off a cliff, at least today. So those inflationary pressures are still there.
So let's bring it back to Canada, because people can watch the U.S. networks if they want to talk about the Fed all day. So here in Canada, we have now seen the benchmark move into negative territory for the year. And I was saying before the break, look, we have a banking system that gets a lot of kudos globally, especially in moments where there are regional banks failing stateside. But let's face it, our Canadian banks have aggressively expanded into the U.S. They have exposure through their business to what's happening there. And forget about the stability of businesses. There's just fear in the market right now. So investors have been selling a lot of Canadian financial stocks. We've been talking about the oil trade, which was one of the biggest bets, arguably, I've heard from pundits all year, is bet on energy. And boy, has that been a whopper of a miss so far. Now, that's not because anybody could have predicted what has played out, but how would you describe what's happening here in the Canadian equity market right now?
Well, I think it's very similar to 2008, John. So, I mean, 2008, 2009, we lost 50% valuation on Canadian banks when we had nothing close to what was happening in the States with respect to real estate or anything else for that matter. I mean, this is probably the most capitalized or best capitalized banking sector in the world. Yet it doesn't help us when we have these situations. People tend to forget how safe and how secure the bank sector is. So, yeah, I think Canadian financials have been hit disproportionately, just like I can say JP Morgan has been hit disproportionately from what has happened in California. And is that a buying opportunity? Yeah, possibly. And on the energy side, I'm in that camp because I've been touting energy now for like 6 weeks, and we've dropped below that technical level on crude. The oil sector goes too, and those are your two big sectors in the TSX, so no wonder that the TSX is underwater.
So what are you doing? Have you been selling stocks? Have you been changing because of what's happened over the last week?
Well, we're looking at opportunities. So three things. First of all, the bond market, and we've been piling into government bonds over the last 3 months, have now gone to the ceiling, to the point now where, as much as I still say bonds are good, it's time to take some profits on bonds, just because of the move
because
that we've
they
seen.
can be volatile, even though you know the
Exactly.
idea is, oh, you get paid to wait, yada yada yada.
Well, you get the inflation narrative coming back into this, John, because I guarantee in about a couple of months we may forget about what happened over the last 8 weeks with respect to Silicon Valley Bank and Credit Suisse, and we may get inflation prints that are worrisome to the point where the bond market has to respond to that. So I think taking some profits on bonds, we are looking at energy to add to there, and to be quite honest, John, we're looking at the U.S. banking sector right now as an opportunity to start piecing in some positions.
The part that is hard as a journalist in all this is that, you know, our job is to make sense of what is happening and what people are saying. But, you know, you referenced 2008, and that scares people to hear references to a global financial crisis. Now, this is a crisis of sorts, but are you anticipating this getting to a point where, like I was working on the floor of the New York Stock Exchange with Bloomberg during the financial crisis, that feels very different in the moment than what we're living through right now. Are you fearful that we'll have that kind of scenario, since everyone had said, well, hold on, we took steps to avoid that kind of situation?
With respect to the financial sector, John, I don't think so. I think this is not just different. I think this is a lot different than what we went through back then. The biggest fear I've got right now, to be quite honest, is that this is actually containable, but we haven't really dealt fully with the inflation issue. And we get central banks, you know, hopefully the Fed doesn't pause next week, but we get pausing, which now gets us to a point where they have to re-engage and start tightening. And then we get the recession story back. So I think recession right now is still the biggest thing that keeps me awake at night, not what's happening to the banking sector.
Kind of feels like you know, there's never an exact comparable, but we're back to talking about the 70s. Period.
In a way, right? And you know, these things will change quickly. You made a point at the very beginning of the interview that this thing is changing minute by minute.
Yeah.
And the next 7 days or 6 days to the Fed is going to seem like an eternity, John, for traders.
Okay.